Hello everyone, I'm Nisha Thakrar. Welcome to Ned Talks, our weekly market series where we discuss recent events and the implications for bond investors. In today's episode, we'll be turning our attention to the US. Inflation may have plummeted from 8.5% to 3.2 over the past year based on US CPI. But the latest minutes from the FOMC's last meeting are a reminder that their work may not be done yet. The dilemma of tightening too much or loosening too quickly, like the 1970s, which left us with stickier inflation, had the committee divided. Meanwhile, support for a soft landing is clearly building. To dive into the different moving parts of this topic, I'm delighted to be joined by David Roberts, a 30-year veteran global fixed income investor. We'll be discussing how the cracks in the economy could still mean uncertainty, even if a recession may no longer be likely, and that could create dispersion among bonds. Why higher for longer is more of a focus than immediate rate cuts, and why all of this suggests income could continue to drive total return generation in bonds, and the old normal is back. Since the 1960s, inverted yield curves, a rare phenomenon in bonds whereby long-term bonds pay less interest in comparison to shorter term bonds, have reliably signaled a recession with about a year's lag. Now, last month, the US Treasury yield curve steepened widely, but now with the market narrative turning to a soft landing, given the slew of positive economic data, David, what are the technicals telling us, and what are the fundamentals saying about the health of the US economy?
Yeah, thanks, Nisha. Yeah, you're right. There is a bit of a disconnect here, and what we're focusing on is the yield curve between the 2-year and the 10-year bond. So that's been inverted now for really well over a year, not long after the Fed started hiking. So that's the first thing to note. I would say that when we look at what happened in the US bond market, to me, the market was, and I believe continues to be, wrong. Really way too dovish, thinking that the Fed would only raise interest rates a couple of times and then probably that would be enough. So that was common thinking 18 months ago. I'd say that bond and cash managers have been and possibly continue to be caught out with what seemed like an obvious move. And certainly, as you say, the dispersion of return between different parts of the bond market has been quite savage and impacted many quite significantly. And it might be that all of that is really a product of lack of experience of tightening cycles. You mentioned like the 1970s, and we have to go back a considerable number of decades to have seen tightening at this pace and on this scale. And maybe that lack of understanding that the Fed has to control inflation and not just always supply cheap money for risk assets is just slowly starting to dawn on people. So those market technicals are still very much in place to indicate a recession, or again, also importantly, that the Fed should be cutting quite quickly. And I'm not convinced that what we've seen from incoming hard data, so whether that's growth, inflation, or employment, really, none of that suggests that the US is about to go into any form of significant slowdown. In fact, to some extent, quite the opposite. And the data, when we receive it, is very much at odds with some of that forward-looking survey data. So the best way to summarize it is the bond market not only is continuing to predict a recession, it's predicting that the Fed will cut and cut quickly, but that doesn't necessarily fit with the hard data that continues to be quite supportive for US growth.
So, one of the topics that you and I have discussed plenty of times is the idea about higher for longer. With US Treasury 10-year yields now going past 4% over the past week, what is actually now being priced into bond markets?
Yeah, that's really interesting too, and it's something that potentially creates quite a lot of opportunity because cash markets haven't really moved that much. They're still saying that there's a chance of about another, there's about a 33% probability that the Fed will raise again. But in all honesty, the market is quite comfortable with the notion that 5.5% on Fed funds, which is where we are today, is the peak. As an aside, in the UK, there's an expectation of another 2 or 3 increases, possibly running through until the first quarter of next year, with peak base rate in the UK looking more likely, according to the market now, to be about 6%. But what has changed over the course of the last few weeks is not the peak in rates, but the time to the expected first cut. That had previously been seen as late 2023, but over the course of the last few weeks, that timing has been pushed out to June 2024 or possibly even beyond. And that fits, I think, with what we've been saying for the last 5 or 6 months, that any thought that rates would fall and fall quickly and aggressively is really not warranted either by the data or indeed the rhetoric that's been coming out of the Federal Reserve. I think to believe otherwise has already been shown to be willful thinking, wishful thinking as well, rather, on the part perhaps of those who are heavily invested in the direction of the bond market. And as we've been saying for some time, you really shouldn't be looking at the bond market as something to give you significant capital gain at the moment. Just concentrate on the fact that the income levels are as good as we've seen for a couple of decades, and that level of income as the key component of your total return over the next couple of years, I think will continue to play a very valuable part as the value part in a diversified portfolio. So for me, yeah, it's absolutely more of the same, yields to remain higher for longer, and really, as you see, as we've discussed, a return to that old normal way of thinking about bond investing, Nisha.
Thanks, David. So just to recap on what we've chatted about today, continued macro uncertainty is going to drive more dispersion in bond markets. Secondly, higher for longer is more likely than any immediate rate cuts. And finally, I guess all of this suggests income can continue to drive total return in bonds. And in your words, David, the old normal is back. Thank you for joining us today. We hope you enjoyed the episode and we wish you a great rest of the day.